Hi, everyone, and welcome to this week's installment of Mish's Market Minute. I am your host, Mish Schneider. Thank you, StockCharts TV. And welcome after a couple of week hiatus back to what I'm calling today as range-bound market, where should we park money? And I think that's the biggest question right now. You're going to hear a lot of different opinions from a lot of different analysts on inflation, on the interest rate rise, on the Russia-Ukraine situation, on growth stocks, on passive investing, on being in cash, etc. And so really, it's a time where I would say right off the bat, that you should definitely be mostly in cash because the market is range bound, and that's what we're going to look at. There's going to be opportunities coming up. We're going to look at that. And there are some opportunities that are setting up now, just looking a little bit for more confirmation, and we're going to look at that. But the idea is that right now, the market is definitely in the middle of a range, trying to figure out whether it's going to respond to the good news that we've seen some growth in the economy this week, that the pandemic seems to be in the rearview mirror, or whether we're going to react more to a hostile situation like we're seeing in Russia, Ukraine, or whether or not the fact that the Fed has to be so aggressive potentially to combat what they've been behind the door on, which is inflation, will that put the kibosh on the market as well? So again, this is a year where you have to be super creative. Everything that worked for you in the past is definitely setting up differently right now, and that's what I hope to give you some insight on. Of course, here's the list of symbols that we're going to talk about. Oh, it says reported, it shouldn't. But these are obviously the macro indicators, outliers. And then here's some of the specific opportunities that are setting up sooner rather than later. So let's go to the charts. Okay, so let's start with the Russell 2000. And of course, you know, I like to start with the Russell 2000 because we did see some industrial production numbers relatively positive this week, which was a good thing. Because you want to see manufacturing come back. Obviously, that's a huge part of the economic growth, if we're going to have any, that has to participate. And it's also a reason why I like to watch IWM as the granddaddy of the US economy. So when we talk about a range-bound market, I have talked about this with you in the past, where as of this low here in February of 2021, we basically held that until more recently. And you can see that we've gone up and down around it. So now that we have a new low to work off of, if I bring my cursor back, we can see that as we started 2021, we really kind of held that low. Here's the beginning of 2021 right here. And that low was 189.15. And the low so far this year has been 188.09. So we're in the ballpark of the range of where we started out 2021 in January before we took off. Now, of course, it's always, you know, a number, not a dead set in stone number, but a range. So if we're going to support that we've already established our range, and instead of, let's say, 1966 to 1982, where it was a 40% range between the high of the Dow and the low, maybe we're more in a 15 to 20% range. And that's certainly legitimate and a possibility, but we need some more evidence of that. So essentially what we're looking at here right now is that we are in a bear phase in the Russells. Why? Because the 50 crossed below the 200. That's negative. That's a negative phase. We see a slope that's still going down on the 50 and starting to go down on the 200. Secondly, even though we did have a mean reversion trade, which brought us to this pop, that's a short-term trade because right now in a bear phase, you have to anticipate that until the phase changes back to a recuperation phase, you sell rallies. So if we look at the original range, the one that really lasted up until the major breakdown that we had, that you can see right here, we really basically at this point now have to get through, say, 208. And even if we get through 208, and we still have to get back through that 50-day moving average. So we're really talking about between 208 and 210 as the major areas of resistance to clear before we can say, okay, it found a bottom, and now maybe we can go back and test up some of the higher levels of the range, which I don't think we're going new highs, just as I said, in the range-bound market. Of course, if you look at the weekly chart, and this is so important to look at, on the weekly chart, it looks a little bit different. We have here a potential bear flag forming in that here's your flagpole right here where my cursor is sitting. And here's your pennant going up the last lows of the last week and connecting the highs of the last week, which tells me now that if on a weekly basis we have more to break down, it's because we're going to see a bear flag pennant break, and that would be a move below 200, especially on a weekly close. A weekly close below 200, and we still have Friday to get through, even though we're $3.50 above it, would probably mean at that point that we could see a move closer down to the 200-week moving average, or maybe somewhere around 175. So heading back to that daily chart, essentially what we're saying right now is we've broken down from the bigger range, we've held a wider range, and right now we're sort of smack dab in the middle, kind of in nowheresville. So this is a reason why it would be very hard to commit a lot of cash to, oh yeah, this is the dip, or you know what, things are going to go much lower. We really just don't know. And what's interesting is IWM is actually outperforming the SPY. So you can see where the bigger stocks and the growth stocks are not where the money is going. People are saying they're buying value stocks. This is the evidence that you see of it right here. Whether that sustains remains to be seen. And of course, momentum is certainly not doing anything all that interesting. So that's why I wanted to start with that. Going into Qs, of course, is a very different situation. We have the 50-day moving average declining, but we're still just in a distribution phase because this is not crossed below the 200 or given us a death cross. This is underperforming the SPY, as we can see right here. Obviously, momentum not so great, anything under the zero line, and not really showing us any particular signs of a bottom here. So what that tells me is that we could have much lower to go in NASDAQ, maybe another 10, 15, maybe max 20% lower. And that would really, if we take a look again at a weekly chart, put us more in line with a move, let's say closer to like 300 or 290. Then I think we could start to say, hey, maybe we're seriously now testing the range here. Now, remember, when I showed you 2021 in the IWM, it was much cleaner. This has been kind of more all over the place. And it had such a clean reversal pattern up here. But right now, we are below the 200-week moving average. And so that's something to consider. So maybe through 360 would be a little bit more enticing. But at this point now, the signal seems to be more to the downside. And with SPY, I'm going to start with the weekly chart on the SPY, because the SPY, unlike what we just saw in the other two indices, is actually holding the 50-week moving average. So interestingly enough, momentum is certainly not great. But in terms of price, we still haven't fully broken down on the weekly chart. So we're still in a weekly bullish phase. However, on the daily chart, you can see we're actually in a distribution phase, because this is now breaking down under the 200. Was there for a minute last week, then popped through. Now it's coming back down. So when you take a look at this, what this is really telling you here is that this could go back down to about 425, maybe 420, and then we can see how the range would hold around those levels. Let's just look at it a little bit wider out like that. That would bring you back to, let's say, the low in July. Or, you know, we could really say that it could even go lower than that if we're going to look at maybe a move down. Let's take a look some historically here. A move closer more down to here, or to about 366, 365. We don't know that yet. But IWM is definitely the most promising of the three of these indices. And of course, if we go here to the diamonds, that too is in your distribution phase underneath the 200-day moving average, and also in a situation where it's held some historical ranges that we've had here going back to September, when it held it around 334. But if we scrunch in, and we start to break down under these levels of 335, 334, then I think we can definitely see a bigger move, maybe down closer to around here to around 310 or 300. All right, so that's the actual indices. So you can see that I have the most hope, believe it or not, in the Russells. In terms of the retail space, this, even with retail sales going up, is still reflecting what we've already seen, which is the whole retail space, brick and mortar and e-commerce, particularly e-commerce with the earnings of Shopify that got killed this week, not doing so well. Now, if we take a look at this here, again, we're in a bear phase in the retail space, and we don't look like we're having any great chance of pop yet, although the momentum isn't as bad. So in order for retail to stop, first of all, 75, if you go back, look at my cursor back at the beginning of 2021, 75 was kind of where we took off from. If we go back up to 75 around here, where we took off from, we had that one test and then we moved up from there. So the fact that this is held around 75 so far is good. But unless we get through 85, it looks to me that if the market sells off more, particularly as we just looked at the Qs and the SPYs, this thing is going to go down to 70 and maybe starts to look really interesting closer to around 60. So people keep talking about a recession. So the technical definition of a recession is 2 quarters of negative GDP. And that's going to be a while before we confirm or deny that. And at that point, it could be, again, sort of rear view mirror, where we may have looked like we were going into a recession, but at that point, we can start pulled out of it. That's why I keep saying stagnation. We're going to see areas of the economy continue to stagnate, while other areas of the economy actually can start to do better. And that's what we'll get to. Now, with next one would be IYT. Now, you know how important I believe IYT is, because this is the whole idea of the economy moving services and goods. So right now, this is in a caution phase. It's better than the others. On the weekly chart, by the way, this is still in a bullish phase. Right here at around this 262 has to hold. So if we get under this 261, we will actually break down on the weekly chart into a caution phase. And that would not be such a good sign. However, look at the range on this one. I mean, we've been down lower than this, even in the fall, down to 240. We haven't even gotten close to that level yet, or relatively close here, with the low was 245. So I think we can head down to 240. That would probably be a really good buy opportunity. But on the flip side, again, if we watch IWM and can actually try to move itself back up closer to 206 to 208, then it probably means this thing is going to get back up above the 50. Didn't confirm here. Notice it broke it over the 50, then went down, broke over the 50, went down, tried to break over the 50 yesterday, now down. We get a couple of closes over the 50 and 270. Then again, that could be another area based on the fact more of the coming back from the pandemic than anything else. Now, if we move on to KRE, this is another one that's in a bullish phase. This is regional banks. Now, we know the banks have done well with the idea of higher interest rates, but nonetheless, the momentum is starting to come off here along with the price. So I see this as a very choppy situation right now, very unclear. Either this will hold or up against these 50-day moving averages and try to work itself up, say, back over 77. Or if it works itself up over 77, it will be obviously, can we get to new highs on the basis of everything else going on? And on the flip side, if we break down, obviously, then we can start looking back at some of these historical ranges, which again is much lower. But KRE is an interesting piece of the puzzle, and it's one of the reasons why I don't see recession. As I said, I see more of a stagnation depending on where you look. Now, semiconductors on the weekly chart are also in a bullish phase. On the daily chart, they are actually in a caution phase because they are holding the 200. Interesting that this is holding up well. Obviously, with chip technology being the major technology of the world, that's one of the reasons we are having chip shortages. So any chips that are being made are being gobbled up as fast as they're being made. And that's one of the reasons why this is still holding up. What would make this really falter, I think, is if we really are truly going from a cyclical to a non-cyclical type of economy, which means people go from buying things that they want to basically things that they need. And in terms of cars and electronics and things like that, in a non-cyclical world, semiconductors would do worse. So when I talk about going into the non-cyclical environment, really basically I would also have to see a confirmation of that, with the semiconductors finally breaking down, and let's say breaking down under 250. And last, in terms of the major macro sectors I like to look at, there's biotechnology, which could be both a cyclical and a non-cyclical, right? As a non-cyclical, one would expect this thing to improve. As a cyclical, obviously, with depending on the economy for research, et cetera, you can see that it's been faltering here. However, I haven't given up hope. This has been in a bear phase the longest of all the sectors that we just looked at. And if for any reason the market stabilizes and this can get back and hold these current levels of around 125 back through 130, I still think that we could see the non-cyclical part of biotechnology take over from the cyclicals. And now quickly looking at the outliers, no surprise that we saw a pop here in the long bonds. The long bonds, of course, were overreactive to the idea of what the Fed might do in March, which is still possible of a 0.5% raise. I would say that that's still very possible. And yet at the same time now, it's still in a very negative phase. So over 140, I think that that would tell you, well, obviously it would probably mean disaster for the market. And if it can hold around 135, that's good. Otherwise, if we start to break down under 135, what you can't see here is that under 133 on my monthly chart, it breaks down over a very long-term trend. And junk bonds, which I also like to look at, have really also given up. We had an interesting, I wouldn't call it a reversal because the high of this high here was one tick higher than that, so it wasn't a clean inside day, but it was definitely a short covering rally and also an interesting mean reversion trade. So again, there is a 10-day moving average. You can't see it here, but it comes at around 103.82. We get through that. That would probably be the reason why we would see some kind of a relief rally in the market. And I'm really, I have to say, pretty super focused on these junk bonds, because through 103.82, I'd be more inclined to be a buyer of equities. If we break down again under this 103, 102.66, which by the way was the low in 2020 in September, then I think we can see a move much lower, maybe closer to around 98. And USO, as we start looking now at commodities, well, USO, of course, is not Brent. This is more of the U.S. reserves of oil, but nonetheless, it's following the overall oil price. We did have a little bit of a reversal top here. It's holding at this point, but considering what's going on, you would think that oil would be much higher. And actually oil, interestingly enough here, is showing some relative weakness. I wouldn't say weak, but relative weakness compared to, let's say, what the silver and gold market are trying to do today. So it's possible that we start to see a move back maybe down to around 60 if this thing fails at these current levels. On the other side, though, if it does hold up and can get back through these highs, which are at 66.88, then I think you're going to see that $100, even $120 a barrel oil. And that's when you really, really, really have to start looking at alternative energy, because more and more people are going to give up buying gas cars and going to EVs. All right, last, well, not last, but gold, which today has this nice gap up. So what's interesting with gold is that with gold right now, this has been a sell strength, buy weakness environment. Talk about range. This thing held that 160 level and popped every time really since really basically last year, it got closer to 178, 179, it sold off. So right now the question is going to be is, do we see buying in strength as opposed to selling into strength? And if it gets through this 179, 180, then I think we're going to see much higher prices in gold. And if you're not already long gold, which we are, then what you want to do now is see if this gap can hold, let's say, by the end of the week. And if it does, you could probably risk just to about 175 to see if you can get a further move up. And then finally, we have to look at the dollar. because in an inflation environment, obviously the dollar is expected to go down, but there has been some safety to dollar. I actually think the dollar, I've been bearish the dollar. I think this was like a false little breakout here. Now has actually put in more like a double top. And I see the dollar going down. And that, of course, will also keep the commodity prices loftier and trouble for consumers as we're getting through the bulk of this inflation. Okay, so what do we watch here? Silver. Again, if you're not long silver, it's still so relatively undervalued. It's mind-boggling to me, actually. Yet our momentum is great. Look at that. In our momentum, we've actually cleared the 200-day moving average in momentum and not in price. So this tells me that you could be patient a little bit and wait for that. What I'd like to do, we're already long silver as well, but what I'd like to do is figure if this can close the week. Let's take a look at a weekly chart here. This can close the week out over, let's say, 22. And I'm just going to make this a little bit bigger so you can see what 22 looks like. So here's 22 right here. This can close the week out above 22, even though we had a weekly close there a few weeks ago. I think that that could also be a good sign. Obviously, we have to look at this 50-week moving average. And if we go back to the daily, we also have to look at this 200-day moving average. But nonetheless, to me, this is more of a fundamental play. We had some new good sharp bottoms down here that held. And of course, we've had trouble getting through these levels. But once silver gets through really $24 an ounce, I think you're going to see this go up. Another opportunity is GDX. This was another one that had great bottoms down here and now is defying the odds, finally clearing all of this, going back to levels that hasn't been since the summer. The momentum here is definitely great. Take a look at this down here. It's just flying. So at this point now, you have a little bit of resistance up here at around 35, 35.20. But if that can clear, again, if we're looking at a weekly chart, we just got back over that 50-week moving average. I see no reason why we can't be looking at prices here closer to 39 before we reevaluate. So that would be another opportunity. And yet another opportunity here is in wheat. And with wheat, let's go back to actually to a daily on wheat. We have not gotten a close in wheat over 780, except for this one little blip that we had here in the fall. I think a weekly close over 780 in wheat also gives you another opportunity. Wheat also, to me, looks like it has a tremendous amount of potential to go much higher. And even if the Russia-Ukraine situation was not the catalyst, you have a tremendous amount of drought all over the place, including here where I live in the Southwest. A couple more, I think you got to look at sugar. Obviously, if we look at spot sugar right now, over 1820 was my level. In cane, which is the ETF, you had some really nice bottoms here at 870. So that's your area of risk. It has to hold 870. And even though it's below the moving averages, I think if you can get a close here above all of this, really today's high, which would be over today's high is what? 89, 890, 891, then I would take that 20-cent risk to see if this thing can move higher too, because I still think that sugar has a tremendous amount of potential as well. One of the things I've been watching carefully, of course, is cannabis. Now, cannabis broke down over the 50. Now it's testing back over the 50. What you can't see on my weekly chart here, since I don't have exponential moving averages, is there is one that hasn't cleared in like months and months and months, up at around 25.60. So at this point now, rather than try to be first in, and here's by the way, interesting, is the Bollinger Band here. Over this 25.60, I'd be a buyer. Right here, I would be patient. If over the course of the next few days, the market stabilizes and it breaks down, doesn't break down under the 50, that could be another opportunity. But really, until we clear that 25.60 level, but I still like it. I still think that that could actually continue to be a trend. The other is China. I think I had told you about Greece. We had bought Greece. Greece gets through 30. That also could have a new leg up. But now China is something I'm watching. And again, on the weekly chart, it has to have a weekly close over 38.33. And if it does, I would be a buyer with a risk under 37 and then take another look to see what happens as it gets closer to 40.50, that 200-day moving average. PBW, I'm going to show you this because it's a ETF for clean energy. So this is what I'm talking about. With the oil prices now, they're coming off, so there's no big rush. But we did have a really nice reversal bottom here. If you look at the momentum, it looks like it's starting to push against the 50, even though price isn't there. I think if you can get a close, especially on a weekly basis over 60, it's worth a small position. Otherwise, it would behoove you to wait for a phase change. But nonetheless, to me, forget about the technicals. It's a fundamental play. If we actually indeed see the oil prices take another leg up, I think you're going to see money rushing into here as people start to say there's got to be another way besides oil and gas. And two more, X. What interests me about X is when you look at the monthly chart in X. Let's see if I can get a monthly chart here on here. Yes, monthly. You look at the monthly chart on X, take a look at these last several months of X. You literally have a sideways action over the last, here's 2021 where it starts. So since 2021, between 15, really, and I'm not even going to say this, I'm going to say between 15 and 29, or no, is that 29? Excuse me, 27, have been the range. This tells me now that if X can take out the range over the last 12 months and also would be over the range of the calendar range high, then this too would be an opportunity in steel. It's been compressing and consolidating for 12 months. And last one, based on the non-cyclicals, we've talked about it before, is consumer staples. This is a monthly chart. Let's go to a daily. If you look at the daily chart in consumer staples, it sold off, but it held the bottom of these more recent ranges. Here's your 50 sloping up. Your momentum is still meh, but getting better. And if we can get a couple of closes, say, over this 75, 70, 76 level, excuse me, then I think that that would be worth a shot with a tight stop. I would not risk too much. You could risk all the way down here, but I would say it either goes or it doesn't. So maybe I'd risk to under 74.50 to see if we can get another move up in actually consumer staples as people buy what they need and not necessarily what they want. Okay, that's it for now. Hope it was helpful. You all have a great weekend. Thanks so much for watching, and bye for now.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.